Hello everyone, welcome to Daily Editorial Drill, and today's editorial we have chosen from Business Standard titled as Rate Cuts Can't Shift Growth Gear. It has been authored by Mr. Debashish Basu and has been published today, that is on 16th of June. Now this editorial begins with the discussion that on 6th of June, that is very recently, RBI sliced the repo rate by 50 basis points and the cash reserve ratio by 100 basis points. You must have heard it in the news. Now, the author argues that the present monetary policy stance by RBI is not enough to shift growth gear as a part of the Indian economy. Why is it so? Basically, the author says that the present Indian slowdown is primarily because of the deep-rooted structural issues in the Indian economy and not the cyclical. So basically, author says that there are primarily four pillars of growth. The first is consumption, then exports, then private investment, and then the government expenditure. The author says that if we talk about consumption, then the private final consumption expenditure has gone down from 68% in pre-COVID times to around 60% in financial year 24, which represents weak consumer demand. If we talk about exports, the trade deficit has gone high and also the exports have become weaker. Why is it so? Because of the poor performance of the manufacturing sector and also large mismatch between productivity and cost structure as compared to the global peers. The third is private investment. The author says that the private investors' confidence has gone down. Why is it so? Because of the uncertainties in the Indian market and also because of the weak demand. The last pillar is government expenditure. The author says that basically from financial year 20 to financial year 25, the GST revenue has increased sharply. It has shown the growth of around 19.46%. So keeping that in mind, what the government did, government announced maximum outlay of $10 trillion. But if we talk about the actual capital expenditure, over there, the performance has remained weak. It has shown a lot of inefficiency, and because of this, what has happened, our revenue deficit has gone high, which is an unhealthy sign as a part of our economy. Now the author says that alone this monetary policy stance, for example repo rate, the cash reserve ratio, these are not sufficient to stimulate the growth. What we require, we need to bring reforms as a part of our structural issues also, for example related to the spending of the government, for example the red tapeism, for example the broken rule of law, for example the high cost of doing business. These issues are meant to be addressed if we want to shift the growth gear with respect to the Indian economy. I hope it is clear to you. Do write in the comment box whether it was helpful or not. So thank you so much and all the best.